All right, welcome back. My next guest had some very interesting observations in his research note this morning. And one of them I found compelling was our guest's views on an often followed data point called the Buffett indicator. Right? He states, at the risk of committing financial heresy, I think it is outdated and anybody using it these days will be left wishing they hadn't been using it. Now, he goes on to give us some reasons why, and we're going to hear some of those, I think. Our guest also had some interesting things to say about Tesla. And today, Tesla trades around about $440 a share. He thinks it could go to $600 a share and could possibly maybe even see a market cap of $20 trillion. Now, there's a lot to unpack here, especially going into the fourth quarter. Let's hear it straight from the analyst himself. Please welcome to the show, Mr. Keith Fitz-Gerald. Keith, thanks for coming on. The old Buffett indicator, you say people may be left behind if they're still looking at it, and you give some reasons. What are those reasons?
Well, thanks for asking and thanks for remembering. First of all, I mean, this is a market indicator that's been around for a long time, but the problem that people have is classic. The markets have changed. So why are you going to use something that was invented for the last century and expect different results? It makes no sense. So here's the breakdown, right? Is that the Buffett indicator compares US GDP to US stock market cap. But today, about 50% of the S&P 500 sales come from overseas. So the Buffett indicator looks cooked, looks terribly overvalued. But when you factor in the international numbers, that thing comes back down. Point number two, the markets have changed structurally, AI in particular, digital investment in particular. The measurements driving GDP and market cap don't necessarily reflect those, particularly given modern accounting. So that makes the numbers out of line. And finally, third, the way the markets function is entirely different, which means that the Buffett indicator can in fact run at 100, 125%, 200% for very long periods of time. And yet the markets can still reach new highs because all of that capital is looking for a home. So, it's the classic value investing 2.0. Anybody looking in a rearview mirror is going to be waiting potentially a long time on the sidelines for a rally and a pullback that they thought was coming, but never arrives.
It kind of reminds me of a lot of these artificial intelligence models people build. They used to call them black boxes when you and I were younger.
Yeah.
But there was never a situation. They always were looking for that situation where you can set it and forget it, like Ronco, and let the black box go. But you can't, because things change dynamically, right, and you have to keep going back into your black box. And I kind of feel like that's what you're talking about when you talk about that Buffett indicator. Things change dynamically, and you're going to have to go back and tweak some things, don't you?
Well, you do, and this calls into mind something else. It's a national sport on Wall Street to back test every model, right? But back testing, if you look at 5-10 year periods, doesn't work, and it's not worth the paper that it's printed out on because of the very changes, particularly, Scott, over the last 10 years where you've had the rise of zero DTE, passive investing, and computerization, and now with 24-hour exchanges coming online, all of those calculations, all those technical indicators are highly computerized, highly understood, highly well known, which means you got to come back to basics. What's value, what's human psychology, and which companies are going to put the numbers on the map. I think it's a great time to be an investor, actually.
Awesome. Yeah, I agree. Awesome. And then that leads me into my next subject, or your next subject, Tesla. Now, full disclosure, I own it. I think Elon Musk is a visionary. He's kind of like artificial intelligence to me, too. What are your thoughts here? I mean, because I know that they're bullish. What say you?
Well, I've had $600 on a map for a long time. My friend and colleague Dan Ives put that on the map last week, and everybody went, wow. And I said, well, gosh, vindicated. This is great. I have company from a super smart guy. I also own Tesla. I intend to own it probably for the rest of my investing lifetime because I think the value creation potential is that high. I think we take out $600, but then when we have Optimus, FSD, drawing, AI, all kinds of data, rewiring the electrical grid, he is playing chess while everybody else is playing tiddlywinks. It's not even checkers, it's tiddlywinks. And so the value creation to me is infinite almost. I mean, we're talking 2030, 2040, but we get to that $20 trillion valuation. But interestingly enough, and much to my surprise, he commented personally on my observation saying it's absolutely possible with flawless execution. So doesn't get much better than that.
Maybe even without flawless execution, because one of the little slivers of things that he's talking about revenue-wise that he's already starting to implement, which what I love, is the fact that this idea about robots.
Yep.
That the numbers, when you start to do the numbers in a bigger, more macro way, boy, it's easy to see where you come up with some of your numbers, right?
Well, you're going to redefine labor. You're going to redefine the concept of work. You're going to redefine mobility. You're going to redefine productivity. You're going to redefine efficiency in ways that current spreadsheet gangs just cannot get their heads around. This is why Wall Street has missed a lot of this historically, is because if they couldn't model it, they pretended it didn't exist. And suddenly, here you've got a model that's based on things that absolutely do exist and are already changing the world we live in, and importantly, the investing landscape.
So, I have to ask you this because you're going to give me a great response, I'm sure, but there's a lot of folks out there talking about, hey, some of these valuations are they're stretched. They're big time to the high side. What do you say about these valuations that we're finding ourselves in right now with some of these stocks?
Well, there's no doubt that they're stretched when you look at historical models, right? I mean, the PE ratios and other things. But let's talk about a real life example. Back in 22 or 23, I think it was, Nvidia was priced at 65x forward-looking earnings. Well, the 25 numbers came in more like 12 actual. So you got to constantly look forward, and you got to see the companies that can execute are more than capable of bringing those numbers into line. And point number two on this is that those numbers, the PE ratios in particular, are based on outdated accounting that is amortizing expenses and things and valuations over a long period of time. Today's world, when you have digital expenditures, those go straight to the bottom line. So of course you're going to have higher PE ratios because you've got the expenses absolutely incurred today, yet the revenue coming on board incrementally is 95% margin every dollar they add in the future.
And if you take those big high-flying tech stocks, the Mag 7 and such,
Yep.
out of, say, the S&P 500, your valuations they look a little bit more normal, too. So it's the AI stuff that's really booming, and it should, by the way. It really should. And to your point, a lot of these things that may look overvalued, given 18 months, they grow into the valuation, don't they?
Exactly. Exactly. Well, and the other thing, I hear a lot, and I'm sure you do too, is that, hey, the markets are getting really narrow. There's only 7 companies leading. Well, people forget their history. In the 1950s, you had GE, AT&T, Standard Oil, all sorts of other companies that were concentrated and were 5-10% of the S&P 500 all by themselves. So today's alignment, today's concentration is not out of line with historical changes in our country's history, in the national fabric of society. With AI on the map, I submit history shows very clearly that the markets always concentrate when there's change in the wind.
I was a professor, an adjunct professor of finance at the University of DePaul, or DePaul University in Chicago. Keith, they would love to have a guy like you around because you make it so easy for everybody to understand. You put it succinctly. I mean, it's fantastic to hear how you put it because we all hear these new things, a new paradigm or this and that. And, when you really take us back, you look at the history, you look at the common sense, and all of a sudden it all makes sense because of the way you laid it out for us. I really appreciate it. Thank you very much. Great content as usual. Mr. Keith Fitz-Gerald coming all the way from Seattle, Washington for us today. Thanks for being on the show.